Hello everyone, my name is Ben with IncomeOptionsTrading, and today I wanted to go over a trade that was created by Tony from Mexico. He's presented it a couple times on the tastytrade network. So this trade is called the ZEEHBS. It stands for Zero Extrinsic Hedged Backspread, and on the screen here you can see the risk profile. So with SPY at just about 427, you can see that to the upside it's basically a 90 delta trade. In this case, there is a value of death for a smaller move here, and then if there is a crash, you can also make money on a crash. This is the risk profile. I'm going to go over some of the basics here. So I just switched the trade here to the classic zebra trade, which is the zero extrinsic back ratio spread, and it's simply a sell an at the money call once and buy two in the money calls and try to get your extrinsic value as close to zero as possible. So this is basically a stock replacement strategy where above 427 you make money 1-to-1, and to the downside you have limited risk unlike stock. The only difference is between 427 and 423. In this case you lose 2-to-1 because you have two calls long and one call short, but this is defined risk where stock is technically not. So this is what Tony from Mexico wanted to fix, basically, is instead of having a flat loss here, this turns around and goes up, so you can make money in the event of another COVID crash or some type of scenario that way. I'm going to use SPY in my example. I think it's sized well for most account sizes. If you want to do this on a smaller notional value scale, you can use the micro E-mini S&Ps, which is /MES. This is half the size of SPY. If you want to get larger notional value, you can use the E-minis, which is /ES. That's 5 times the size of SPY. And if you're a big dog, you can use the SPX, which is 10 times the size of SPY. But I'm going to use SPY, like I said, for this example. So for the ZEEHBS trade, Tony puts this on every Monday morning for the expiration of the following Monday. So I'm going to pull up the calendar here. Today is actually Saturday. So if I were to put this on Monday, the 28th, I would put it on for the expiration expiring on the 5th. This is a special case because on the 5th the market is closed due to Independence Day. So I'm actually going to use the July 6th expiration for this example. So I'm in SPY, go to the option chain and do July 6th. Open that up. And for the ZEEHBS trade, I'm going to start with the zebra, which is selling an at the money call and buying two in the money calls and trying to get the extrinsic value close to zero. SPY closed about 426.88 in the aftermarket on Friday, so I'm going to use the 427, and I'm going to move these in the money calls until the extrinsic value here goes to zero. You can see that the buying power for this trade is 776. That's my max loss. We can go into the curve mode here, and if I turn off all my other trades, here is that zebra setup that I had before. So we want to get a kicker here. So what Tony did to start is he actually would short 50 shares of SPY. And if I'm going to do that, I actually have to do that first. So I just clicked on the bid here, and you can do short and change this value to 50. And then I'm going to do the same zebra trade, and now that 50 shares is in here. So now if we go to the curve mode again, you see the ZEEHBS risk profile that we had before. So this is the cleanest way to do it. The only problem with doing this one is you can see down here that the buying power is almost 22,000, which is quite a bit for most people. So instead of actually shorting 50 shares, one alternative is to short one MES contract, which is the equivalent of 50 shares of SPY, but then you have two different products. So what Tony does is he uses a synthetic option position to get short. So to get short 100 shares of SPY, you can buy the at the money put and sell the at the money call. This gives you 100 delta, and if we look at the risk profile, it's the exact same as shorting 100 shares of SPY. It uses about $8,800 in buying power compared to, if we just short shares, 21,000. So the option synthetic is much more leveraged or a lot less buying power. Unfortunately, you can't do half an option. So the synthetic short position would have to be 100 shares. The ZEEHBS uses a 50% hedge. So in order to pull this off, you would have to double the zebra size. So what I mean by that is instead of selling 1, buying 2, we would buy 2 and sell 4. And then we put on the synthetic short position, which is a short call and a long put. And it doesn't matter what strikes the synthetic short is. You want to go as close to at the money as possible because that's where our bid-ask spread is the tightest. So you can see the 426, 427. It's 4 to 5 cents on both sides. You could do the 426 or you could do the 427. And I just noticed that it actually gave me a quantity of 2. So I'm going to reduce that to 1 because that's what we want. So that would give us short 100 shares. If we went to the 425, this is still synthetically the same position, but the bid ask on the in the money positions tend to get wider. And if you were to double up on the 427 here, you would sell 3 here instead of 2. But for this example, I'm going to try to keep it a little bit simpler and just do the 426 strike. So we have the back spread portion, which is the 423, 427, and we have the synthetic short, which is at the 426 strike. And this buying power reduction is only $1,500, which is a lot less than the $22,000 that we needed for the 50 short shares of SPY. And this is actually twice the size as the previous one. So if you go to the curve mode, we have the same type of setup. Our valley of death max loss here is double because we did 2 zebras instead of 1, but our stock 1-to-1 going up and going down over here is both twice the size. One thing I forgot to mention, if you are using the 50 short shares of SPY, just be careful with dividends. With short shares, you're responsible for paying the dividend. So just watch out for that ex-dividend date if you're using short SPY shares. And then I kind of touched on this. The value of death here is your worst case scenario. Basically, what you don't want to happen is for SPY to gradually go down and sit at 423 on expiration. That's where your value of death is. So you want it to either go up or you want it to crash. If it's a 1% down move over the week, that's kind of the worst case scenario. The other thing too with this risk profile, this orange line here is the theoretical line for each day. So even if, say you put this on Monday and it's either Tuesday or Wednesday and the market goes down to 420, you're not going to be at this low mark here. You're going to actually be above at this orange line. And that's because these strikes are still going to hang on to their extrinsic value. So you're not going to lose all of it all at once. Let's move into the different adjustments you can make on this trade. If the market goes up, which is what you want, throughout the week on Thursday or Friday, you could take off the 2 long call spreads, which is the 423, 427 in this case. So you would buy back the 427 twice and you'd buy 2 of the 423s. So then you'd be left with 2 of the 423s. And what that does is it raises the value of death. So your risk is less. It actually takes off 50% of the risk. So it locks in a little bit of profit, but you still keep your potential gains to the upside if the market continues to rally. Alternatively, you could take off the entire position if you think the market's going to reverse either on Friday or over the weekend. Monday morning, maybe after the first half hour, then you would close this position down and recenter and put on the new one for the following Monday expiration. You just want to be careful on that Monday that it expires. Due to gamma, these extrinsic values are going to decrease pretty rapidly. So if the market doesn't move up or if it moves down, you can lose a lot of the profit you have. So don't hang on to it for too long after Monday morning. So I'm going to add back the 423 and 427 to long call spreads. So we have our original position on. So here's our back spread 2x4 in our 1-to-1 or 1x1 short synthetic back on. So the upside adjustments, that's good. You're taking profits. Everything's good and dandy in this bull market seems like every single week is an up week, so you'd be taking profits every week, which is good. But the hard part is when the market goes down and you have to adjust your trade. There's a couple different options that you can do when the market is going down, and it's usually a slower grind down that hurts. If you wake up and the markets goes from 427 down to 423 or 422, then I wouldn't be as concerned because you're already past your value of death. And if the market keeps moving down, then eventually be making profit. So with that, I usually wait till Thursday or Friday again for my adjustments. And if the market is slowly moving down, what I will do is I will move the short calls of the back spread down in value. I would roll the 427s down to the 424s. So I would buy these back and then sell these out. Oops. And that takes in additional credit and it reduces the value of death. So basically just takes in a little bit of extra profit and reduces your risk a little bit. The downside is you lose a little bit of your upside potential. But when the market's going down, you're more worried about reducing the risk typically. So I move this back to where it was originally. The other alternative you could do is, let's say on Thursday or Friday, the market moves down to 424. What you could do is buy back this back spread. So I would delete both of these. And I would recenter a new zebra position with your short at the money. So if it goes down to 424, I would do 2 of that. And these option prices would be a little bit smaller, so maybe instead of a 427, 422, you do a $2 wide instead of a $5 wide. But you would still do the 2x4 back spread, and you would still do the same expiration. So if it's Thursday or Friday, I would do the Monday expiration, and then after the weekend on Monday morning, if the market rallies, this is a way to make more money if it turns around. So I'm going to move my position back to the original here. It was actually the 423, not the 422, so I misspoke there. But the third alternative for when the market's going down, so right now we have 4 long calls and 3 total short calls, so we can sell 1 more call and still be covered. So as an alternative, you can simply leave everything and just sell 1 more additional call. I can't click on it now because I can only do 4 legs on Tastyworks, but I would just sell, say, the 424 call, and that would reduce your risk as well, and it would also cap your upside to 427. Let's say I sold another 426, so now I have 4 long calls and 4 short calls. You can see that it caps my upside. So now on my upside, it's just once it gets up to the short leg, then it flat lines. But it reduces your risk and it reduces your max loss at the value of death, and that's what you're looking for. So go back to the original. And the last thing you can do is sell back this long put. So if the market goes down, this put should increase in value, and so you can take advantage and sell that, but then you lose your downside protection. So if we look at the analysis tab here, it flat lines on the downside and it looks more like a typical zebra trade, but you can lose less at the value of death portion. So the buying back the long put and selling an extra call are the 2 things that I typically don't do. I like to roll the short call, the back spread, down to reduce my risk. And one other thing to mention with that, I wouldn't sell or move the calls to below your long calls because then it's a short call spread. You want to keep it above your long calls so that it's a debit call spread to stay bullish. So if you move it below, now you've turned your assumption from bullish to bearish. So that's the ZEEHBS trade. Basically kind of looks like a long straddle, but the only difference is this has 0 extrinsic value or close to 0 extrinsic value, and you still have the same type of straddle look to it, but you have a deeper value of death just to the downside. That's the con to doing this sort of trade. I like this trade because the market doesn't go down 1% several weeks in a row. It seems like if it goes down 1% 2 weeks in a row, the next week it's either going to be up 5% or down 10%. So if you do this trade every single week, yes, you're going to have some losers, but it seems like in the long run, this trade should be profitable, especially with this bull market that we've been in for the last 10 plus years.